The key thing from a technical point perspective to look at with gold and silver is gold has breached critical resistance in 1900. It's trading above and has been that way for almost a week. Silver hasn't quite challenged 2450. If gold stays above 1900, I think silver can challenge 2450 and gold could drag it up. And gold. Hey everyone, this is Rob Keens with GoldSilverPros.com. This is your weekly market wrap. We're recording this on January 16th, 2023, a little bit late this week. Thank you everybody for joining. As we speak, the gold price is trading at 1950.63 at about 9:30 a.m. Central Time. It's down $1.61, about even on the day. The same for silver, trading at 24.22, down about 7 cents. Overall, not too bad. It's important here to note that the gold price has breached a critical resistance line of 1900, which was the 2011 all-time high. Certainly not the all-time high. We saw an all-time high of 2069 in 2020 during the pandemic and the shutdowns. But it's interesting to note that gold has punched through this last all-time high because it is a major support and resistance line. Now it's acting as support. We see gold trading above it. We'll see if gold holds that 1900 line this week. Silver hasn't quite followed gold through its big mark. The next big mark for silver on the charts is 2450. We're trading right now at 2422. So silver hadn't got quite as frothy as gold, but if gold stays above 1900 this week, I think we can continue to see silver challenge that key 2450 resistance level. We got some big news last week in terms of the economy. Most of the Fed members spoke, and they think that we can ease the rate at which we get to 5%, but 5% is the new target. And they also think the 5% could be the target for a while, indicating that we may be dealing with some fairly persistent inflation. And so they're going to keep interest rates up. It didn't seem as though they wanted to ease anytime soon. So I think 5% is really their target as we head into the next recession, which makes sense. That is basically the benchmark rate that most of the big guys like the BIS and IMF and the research say you need at least 5% during the next recession so you can ease into that recession. And so that's why they've got that target there. We'll see if they continue to raise over 5% and how the economy is producing. Right now, the small business index comes in at a 6-month low. It declined to a rating of 89.8 upon expectations of 92. It just means small businesses are not seeing everything be too rosy. Wholesale inventories increased by 1%. Again, we expect to see inventories continue to increase as a little bit of overhang exists with the consumers, although consumer spending was okay. Consumer sales were up 7.6%. Retail sales jumped 7.6% during critical holiday shopping season. And I said that we would take a look at that and look at the early data and see, depending on that number, it would make things seem very positive, and then the economy rebound, and we'll get to the economy rebounding here in a moment. That seems to be the case. So it was nice to see a 7.6% increase. However, playing devil's advocate here a little bit, the CPI during the same month was 7.1%. So if you net those out, we had a very modest increase in spending during this holiday season, but at least it wasn't negative, although the market's going to read it as we increased quite a bit more than we actually did. The core CPI came out last week and it was down to 6.5%, fell from 7.1% the previous month. That matched economists' expectation. That means we're in the deflation cycle of the triple top inflation deflation before we have the big crash. We had a big inflation last year. Now we're starting to go into that deflationary pattern. We'll have another deflation pattern, and then one final if that pattern holds from the last 2 times we had big inflationary episodes. So we expect the economy to continue to deflate here for the next probably 6 or 7 months until we get our next bout of inflation. We'll keep on top of that. CPI excluding shelter was down 1.6%. So across the board, prices were falling. Initial jobless claims came in at 205,000 last week, under expectations of 210, which is very positive. So jobs seem to be holding serve, not really going either way, one direction, just sort of holding serve here, considering the fact that we've had a lot of, especially tech companies and retailers say that they're going to be laying off. It's pretty remarkable that jobs have kind of held like they have for last month. We'll continue to follow that data for you guys. The federal budget, we spent $85 billion more than we made last month. That's basically been true for a long time. But in any case, the spending is still there. We'll take a look at the markets as we're reporting this about 9:30 a.m. The Dow is up 112 points. The S&P is up 15 points. The NASDAQ is up 78 points. And the Russell's up 10 points, all up between 0.4 and 0.7%. Last week, the markets did very well. They had a nice little rebound. The stock markets did, and it wasn't too bad. Looking at crypto markets, boy, on the 14th, all the crypto markets jumped almost at the same time. Bitcoin jumped Litecoin jump, Ethereum jump. Bitcoin now is trading at 20,976, up 89.82 on the day. Ethereum is trading at 1550.92, down 0.2, which is basically even. Litecoin is down $2.22 to 86.07. XRP is trading at 38 cents. Unchanged. Overall, cryptocurrency is not doing too bad. The bond market is faring pretty well. Rates have come down since the scare we had a couple of months ago. They're still elevated, but right now the 2-year is trading at 4.224%, and that is inverted to the 10-year, which is trading at 3.498. In fact, every bond issuance shorter than 10 years has a higher interest rate, which means the market still expects there to be a lot of short-term or immediate risk. This is screaming recession. We think we're going into a recession. Now, I just told you retail sales grew, but we have earnings reports for the companies. We'll see how that goes. Remember, you have to take inflation and debt into account, and we'll see if we actually grew during the fourth quarter. But the market is still expecting a recession, and that's why you see those bond markets in yield curve inversion, where the shorter term issuances are demanding more yield because they see more risk in the short term than they do out at the 10-year, which is opposite of what we typically see. Overall, the market's not too bad. They're kind of holding serve. We're going to get into the share screen part of the program, and we're going to take you through gold and silver and what we see there. Here we have the website for the CME Group, where the data comes from the futures markets in gold. And those you following along for any length of time know that this is where the spot price is determined. You can see that here in this price here, and we'll get into the settlements here in a moment. We're looking at volume, and we had a nice spike in volume last week of gold. There's a lot of frothiness in the gold trade. Let's see what's going on there. We had 257,000 contracts. This is Friday's data right here. You can see 257,000 open interest contracts. We had 3,343 of those move from the US over to London. And that EFP trade, the exchange for physical, where people are taking their position here and they're hunting for the physical metal over in the London market, which is kind of a sister market in a way. They're loosely connected in the Western world, or they may be playing price arbitrage between the two. We've seen a lot of that lately. People are going over to London for gold exposure, which is interesting. Makes one wonder, are we a little bit short of gold stocks on COMEX, or are people just not getting the prices they want? Is there an arbitrage opportunity across the pond between their gold price and ours? And why does that exist? And why are people shifting trade over? That's a narrative I haven't really seen anybody write about. We'll dig into the data and see if we can figure something out for you guys. That was Friday's data. As we pop down to Thursday, 271,000 contracts, 2,636 EFPs overall. Interesting trade. Let's see what we settled at. And this is all out on the February contract for gold. It'll be March for silver. We'll go over that in a moment. Estimated volume on Friday's data, 263,000, trading up $22 to end the week at 1921.70. It was a good week for gold. So we go back to Thursday's data, up $20 to settle at 18.98. And you can see the trend here, up $2 on Wednesday to settle at 18.78. And then on Tuesday, it was down $1. So began the week a little bit down and then rose as the week went on. Nice solid numbers here. A nice trading volume for February. Not too bad with gold. Let's take a look at the tail of the tape in terms of the ETFs. You can see here there was, before we get the ETFs on the COMEX, there was a reduction of about 1.2 million ounces gold over the last 4 weeks. So COMEX has lost about 1.2 million ounces over the last 4 weeks. The ETFs have gained about 300,000 ounces. It looks as we net that out, 1.2 million minus 915 is about 300,000 ounces have come into the ETFs. So a little bit of gold flow back into London as most of the ETF gold is held there. It just seems like maybe there's a little bit more positive going on in London, a little bit more flowing out of the United States. And we saw that in the EFP trades, the exchange for physicals. People are hunting over in COMEX and finding maybe more on London. That's a very interesting little dynamic we'll follow and see if that continues. Again, the overall from the COMEX has been for gold to flow out. Now we're looking at the ETF, the SPDR GLD. And you can see that that gold has been flowing out since silver squeeze, interestingly, the beginning of last year, over a year ago. It seems as though gold has been flowing out. Let's take a look at silver futures, if we will. Volume was elevated towards the end of the week in silver as well. It got frothy and to the upside. And I'm going to show you in a moment who's driving this trade. And it's not who you think it is who's driving gold and silver. It's an encouraging sign. We'll get to that in a moment. March is a dominant contract for silver. You can see here on Friday's trade data, Friday right up here, we had 110,000 contracts of 5,000 ounce silver close, and we had 282 FPs over to London. Not too bad for those numbers. If we look at Thursday, we had 109,000 open interest. Total volume on the day was 73,105. Of that, 400 EFPs for the Thursday's data, and we'll go back to Wednesday as well. On that March contract, 109,000 of open interest at close, 57,000 total settled, and EFP of 825. Let's go to the settlements and see the price action. Again, on the March contract, this is Friday's data. We load Friday right up there. You had estimated volume of 61,000 contracts. They settled up about 37 cents on the day average to 2437.2. And we go back to Thursday's data. The 74,000 contracts, very healthy, settled up 52 cents to 24,004. This is where you get the prices, ladies and gentlemen. Just go to that settlement data on the CME, and it tells you exactly where spot prices come from. That is exactly where spot prices come from. As we look at the silver chart here at Gold Charts R Us, thank you, Nick Lear, for putting this together. You can see over the last 4 weeks, we've lost a lot of silver from COMEX. It didn't matter whether it was registered or eligible. We lost it about 2.4 million ounces. About 7 million ounces have flowed out overall, so about another 5 million ounces have flowed out of the ETF complex. So despite what's happening to the price, people are taking delivery of silver off the Western markets, period, end of story. And that has been the case, especially as we see here in the iShares SLV with their silver stored in London, has been coming out since silver squeeze right there, just like the gold has. People are liquidating that silver. Does not surprise me whatsoever. What does surprise me is who is driving the prices in gold and silver. It's not who you think it is. We're down to the COT report from the CFTC. This is a commitment of traders. It's in arrears, so we've got data through January 10th, 2023. I realize that's about a week old. That's the way the CFTC rolls. We look backwards. Scrolling down to the silver report, you can see here the big change that I'm going to highlight this week. The swap dealers, after having been net long a few weeks ago, went net short about 1,000 on the last COT report, and now they're net short about 9,000 on this COT report. So they've moved, the evil empires moved back short again, if you will. The producer merchants are still short. They always will be because of price exposure, but with the price going up, they have dropped almost 3,000 of those shorts, saying, hey, price is going up. We don't need quite this short position. That protects, our downside price risk. So they've reduced some of those. That makes sense. Swap dealers dropped 1,600 longs and dropped 222 shorts. So for the week, they went net short about 1,400 contracts. The managed money added shorts and dropped some longs, but they're massively long here. And those are the ones bidding up silver, 44,900 long contracts to 21,666 short. They're more than double 2-to-1 long. They're the ones that have actually been driving this because it's as the contracts settle, which drives the price. So it's been the managed money. It's been the financial houses, which have been boosting silver and gold. We'll show you that. Other reportables in terms of they've also been boosting it. This is the family offices and the wealthy individuals. You can see that they've about a 2,000 net long side last week on silver. They're expecting it to go long. So the wealthy individuals and the financial houses all lining up long silver, the swap dealers and producer merchants lining up differently than that. Let's move down to gold. Again, as of January 10th, 2023, you can see the movement here. We always look at the swap dealers first. We consider them the sharps, or basically the house, because they have all the data and do a lot of the trading. So I describe them as the Las Vegas of the gold and silver markets. They basically set the betting line, if you will, for us. And they had added 5,400 shorts in gold and dropped 2,200 longs. So a net of almost 8,000 shorts. So they're really jumping on the short bandwagon on gold as well. The managed money, you can see, took an additional 7,400 longs and only took 236 shorts, or about 7,000 additional long contracts. They took almost all of the 8,000 on the other side, the swap dealers, in the last week. And so they're now long 116,000 contracts to 54. Again, a little over 2-to-1 managed money long on gold and silver. And you see the same thing happen with the other reportables, the family offices. They're up almost 4-to-1, 126,962 long contracts to 38,000 on the short. But they added a net of about 1,700 contracts alongside here if you net out those two numbers. Overall, a lot of interest in both gold and silver, and I believe that market has gotten quite frothy, ladies and gentlemen. And I think the big story really has to do with what is going on with the stock markets. They're ebullient. Retail sales appear to jump, even though if you net it out with inflation, it's not much of a move at all. It's kind of keeping our head slightly above water, if you will. And I think the markets are ebullient to the fact that we didn't have a complete and utter crash everywhere in the economy. The fourth quarter came in at least even in terms of retail sales. We're starting to get those earnings reports this week. A lot of the tech companies are coming out. We'll see over the next couple of 3 weeks, through the end of January, and so how that happens. For those companies that end calendar year 12/31, it may take them a little bit longer to get their reports out because they're doing their year-end accounting, stuff like Sarbanes-Oxley and compliance. And so we may see some of those earnings reports come out a little bit later, but certainly the next couple of weeks will tell us how the rest of the economy outside retail, we know that did okay, outside retail, how that did in the fourth quarter. And that'll give us a good idea of how people are feeling. We think we could have a little bit of a head fake in the stock markets and it continues to march up. Looks like the cryptos are marching up in lockstep with the gold and the silver. If fear is off, that means gold and silver could retrace a little bit, even though it's been up early. And again, I think the gold and silver popped about a month earlier than I expected. I think it popped on worries about what happened last year, but we really have to see what happens with the earnings reports that are coming out for fourth quarter and year end, and the data for year end on how companies did year end and how consumer sales continue to come out from last quarter. If those continue to be rosy, it could actually put downward pressure on the precious metals as the stock markets and Bitcoin, things like that, rise. However, if some of those earnings reports come out and they're not so rosy, and then economists begin to rationale like I am, we had a 7.6% pop in sales, but you also had inflation. Maybe that wasn't quite so good. We may start retracing backward in the economy again. Maybe this pop in the stock market we had last week kind of comes back down and gold, silver begin to rise. The key thing from a technical point perspective to look at with gold and silver is gold has breached critical resistance in 1900. It's trading above and has been that way for almost a week. Silver hasn't quite challenged 2450. If gold stays above 1900, I think silver can challenge 2450 and gold could drag it up. And gold continue to drag silver up quite a bit until we have an event which warrants much, much higher prices. I think that's really the story here, but I'm still interested to see some of that economic data before I call the fact that the markets have come back. Whether we're talking about the gold markets or the rest of the market, I think there's still more to see there, and we'll continue to cover this in these weekly market updates for you guys that we do every single week. Thanks for staying tuned to the channel. We will have more. Until next time, this is Rob Keynes for Gold Silver Pros.